Bullish posts. 87 million revenue, up over 50% year on year. Bullish, the institutional crypto exchange that trades on the NYSE under the ticker BLSH, reported quarterly results before the market open on August 13, 2026, with revenue tracking near $87 million, up more than 50% from a year earlier. The figure was flagged by CoinMarketCap ahead of the print, and it points to sustained institutional demand for regulated trading and derivatives infrastructure. The report arrives during a quiet stretch for spot prices. As of August 13, 2026, Bitcoin sat at roughly $63,527, down 0.01% on the day and 1.6% over the week, while Ether traded near $1,081 and the Fear and Greed Index read 37 or fear. A revenue jump of that size against a flat, cautious tape says the growth is coming from activity and market share rather than a rising market lifting every venue at once. Revenue growth without a price tailwind. Exchange revenue usually tracks trading volume, and trading volume usually tracks volatility and price momentum. Neither was strong in the run-up to this print. Bitcoin has moved less than 2% over the past week, and the mood gauge is stuck in fear territory. A 50% plus year-on-year gain in that environment is the number worth pausing on. That pattern points to two likely drivers. The first is derivatives. Perpetual and dated futures generate fees on both sides of every position and get used heavily by desks hedging or running basis trades, which do not require a directional market to stay active. The second is share of wallet. Institutions consolidating flow onto venues with clearer regulatory standing tend to move volume regardless of where spot prices sit. Bullish came to public markets through its NYSE listing and has built its pitch around serving professional and institutional traders rather than retail. Revenue that grows while retail sentiment cools is consistent with that positioning. The institutional derivatives backdrop. The result fits a broader shift in who is trading crypto and how. Hedge funds recently flipped net long on CME Bitcoin futures after years of holding short positions, a sign that professional desks are treating regulated crypto derivatives as a standard part of their book rather than a fringe bet. Venues that can serve that demand with compliant order books and deep liquidity are the ones capturing the incremental fee flow. This is also the part of the market that has held up while other segments thinned out. More than 100 crypto projects have folded in 2026, and a $1 billion sale of the derivatives exchange BitMEX collapsed when buyers walked away. Against that backdrop, an exchange growing revenue by half year on year is a signal that liquidity and users are concentrating into fewer, better capitalized venues. Reading a revenue headline before the full print, one caution on the number, tracking about 87 milliards, is a pre-report estimate, not audited results. The full filing will carry the details that decide whether the quarter is as strong as the headline suggests, including trading versus non-trading revenue, operating costs, any one-time items, and the balance sheet position behind the exchange's stablecoin and reserve holdings. A revenue beat paired with widening losses reads very differently from a revenue beat that drops to the bottom line. For anyone holding or watching BLSH, the year-on-year growth rate and the mix of that revenue matter more than the top-line figure alone. This is reporting on an earnings estimate, not financial advice, and the official filing is the document that settles the question. The link to everyday crypto spending institutional exchange health is not just a trading desk story. The venues that clear large derivatives and spot volume are the same rails that price the stablecoins and set the liquidity behind the crypto people actually spend. Deeper, better capitalized order books mean tighter conversion spreads when funds move from tokens to fiat, which is exactly the hidden cost that shows up at the point of sale when you use a crypto card or convert a stablecoin balance to pay for something. A stronger institutional layer quietly lowers that friction for the retail end of the market.